All right, guys, welcome back to Father and Son Investing. We're going to continue talking about artificial intelligence ETFs, or at least ETFs that have a large portion of their holdings in artificial intelligence companies. Today, we're going to talk about ARK Invest's ARKQ. That is the Autonomous Technology and Robotics ETF. Now, they are focused on companies that are expected to substantially benefit from the development of new products or services related to technological improvements and advances in scientific research. They are investing in energy, automation, manufacturing, materials, and transportation sectors. This one is certainly not a pure artificial intelligence play. In fact, if we break down their holdings, we'll see that autonomous vehicles lead the way here, almost 43%, followed by robotics and energy storage. So why do I consider this an AI ETF? Well, certainly those autonomous vehicles, those are very AI intensive. And when we get to robotics, those certainly are AI intensive as well. I like the market capitalization breakdown of this ETF. You're getting about a third of it in the mega cap, a third of it in the large cap, and then a third of it in the medium, small, and micro cap. And they certainly have tried to diversify their sectors. You're getting about 30% in information technology, but you'll also get some consumer discretionary and some industrials, not so much on the healthcare with this ETF. So what exactly are you getting if you choose to invest in ARKQ? Well, you're getting a lot of Tesla. In fact, almost 12% of the ETF is Tesla. Now, some people might consider that a deterrent. Some people will look at Tesla and say, wow, it's kind of made its run. I think Tesla is just at the beginning of its run. It certainly has run its stock price up wonderfully over the last couple of years, but it's really only been making money for just, a year and a half now? I think that Tesla is going to continue to grow and crush the market. Now, of the top 10 stocks, those will make up about 55% of this ETF. You can see before you there the top 10 stocks. With this ETF, you'll also get some other companies that you might not expect to be in a autonomous technology and robotics holdings, such as John Deere or Caterpillar. And although it's not very heavy in medical stocks, this one does invest in Intuitive Surgical. Again, they are the makers of the Da Vinci robot, and they lead the world by far when it comes to installation of surgical robots. This is a popular ETF. It has $3 billion of assets under management. And the big thing people really want to know is, what do the returns look like? So we'll compare to our other ETFs in this little series here, and we'll see that ARKQ is leading the way since 2018. Now, that's been sort of a recent development. If we go back as close as October of 2020, really it was running even with the VGT. Of course, the expense ratio, again, on VGT is far less than ARKQ, but suddenly it took off and exploded there, got way out in front, and now is sort of regressing towards the mean. When it comes to the one-year returns, this is as of the close of the second quarter, June 30th, 2021, ARKQ is way out in front, 83%, 83, 84%, depending on if you're looking at the market price or the NAV price. One-year returns. That is incredible. So what's my take for ARKQ? I like it. I like it together with the previous one that we talked about, BOTZ. I like it because each of them do not have a lot of holdings. Some people may see that as a risk. It certainly is when it comes to diversification, but they do tend to concentrate heavily on the companies that they say that their ETF is interested in investing in. And I like the fact that they're not invested in the same companies. Remember, BOTZ, their largest holding is NVIDIA, and this one is Tesla. Now, there are some that are going to cross over and be the same. This one certainly invests in NVIDIA as well. And then in regards to the expense ratio, yes, it is expensive, far more expensive than VGT, but if it makes you a little more money, that expense ratio may be negligible. Hopefully this was useful and informative for you. If you liked it, please give us a thumbs up. We'd love to have you as a subscriber, and please share it with a young person in your life. Until next time, enjoy your investing.